Hi Matrix, welcome to the Durban Online Academy channel. In this video, we're going to be looking at the June 2024 exam paper for Gauteng Province. In particular, we'll be looking at the following financial statement questions. Question 1.2.1 requires us to calculate missing amounts on the fixed asset note. Question 1.2.2 requires us to complete the statement of comprehensive income. Question 1.2.3 requires us to complete the ordinary share capital note. And question 1.2.4 requires us to complete the equity and liabilities section of the statement of financial position. In 1.2 Jonty Limited, the following information relates to Jonty Limited. The financial year ends on 29 February 2024. Required 1.2.1, it says refer to information C. For 10 marks, we are required to calculate the missing amounts denoted by 1 to 4 on the fixed asset note. So then let's have a look at information C, where we are given the fixed asset note. In the fixed asset note, we are told that land and buildings were purchased during the financial year for 1,500,000 rands. This has been properly recorded. If we look under the land and buildings in the fixed asset note, we can see that we have additions of 1,500,000. Depreciation on vehicles is calculated at 20% per annum on the diminishing balance method. The total depreciation for the financial year amounted to 83,200 rands. As you can see under vehicles, there is depreciation of 83,200 rands. On 29 February 2024, a vehicle costing 200,000 was sold for cash for 118,000 rands. The business made a loss of 10,000 rands on the sale of the asset. If you look under vehicles, you can see that indeed there was a disposal, but the value is not given, so we'll have to calculate that figure. Depreciation on equipment is calculated at 15% per annum on the cost price. The company decided to invest in new equipment since the equipment was very old. The new equipment was bought on 1 November 2023 at a total cost of 150,000 rands. So this information relates to the depreciation, which we will have to calculate, and also to this addition of new equipment, which is worth 150,000 rands. Before we plunge into the calculations, it is important to note that the fixed asset note is made up of a combination of equations, and I want to bring these equations to your attention. The first equation is carrying value at the beginning of the year plus additions at cost minus disposals at carrying value minus depreciation equals to carrying value at the end of the year. So where does this equation come from? Well, if you look at the fixed asset note, you can see that if you take the carrying value at the beginning of the year plus additions at cost minus disposals at carrying value minus depreciation, you are going to get the carrying value at the end of the year. So that's where the equation comes from. The second equation you can pick up from the fixed asset note is the carrying value at the beginning of the year equals to the cost at the beginning of the year minus the accumulated depreciation at the beginning of the year. If you look at the fixed asset note, you can see that the carrying value at the beginning of the year comes from taking the cost at the beginning of the year and subtracting the accumulated depreciation at the beginning of the year. The third equation you can pick up from the fixed asset note is carrying value at the end of the year is equal to cost at the end of the year minus accumulated depreciation at the end of the year. Just like we did for the carrying value at the beginning of the year, we do the same for the carrying value at the end of the year. The carrying value at the end of the year is going to be equal to the cost at the end of the year minus the accumulated depreciation at the end of the year. The fourth equation you can pick up from the fixed asset note is cost at the beginning of the year plus additions at cost minus disposals at cost equals to the cost at the end of the year. So in the fixed asset note, if we take the cost at the beginning of the year and add additions at cost minus disposals at cost, equals to cost at the end of the year. It's important to note that in this equation, we use the cost of the disposal and not the carrying value of the disposal. So you will have to know the cost of the asset being disposed. Another equation that I want to bring to your attention is profit or loss on disposal is equal to proceeds minus disposals at carrying value. So basically, if we want to know how much profit or loss we made when we sold an asset, we must subtract the carrying value of the asset we are disposing from the amount we received for the asset. You must be able to manipulate all these equations in order to solve the missing figures in the fixed asset note. Let me show you how. For land and buildings, we are required to calculate the cost at the beginning of the year. If we look at our equations, we see that there are two of them which have cost at the beginning of the year. Equation number 2 and equation number 4. Can we use equation number 2, which states carrying value at the beginning of the year equals cost at the beginning of the year minus accumulated depreciation at the beginning of the year? The answer is no. Why? Because if we look at our fixed asset note, we can see that we don't have any values for carrying value at the beginning of the year. We also don't have any value for accumulated depreciation at the beginning of the year. So we can't use equation number 2. What about equation number 4? Equation number 4 states the cost at the beginning of the year plus additions at cost minus disposals at cost equals to the cost at the end of the year. Do we have a value for additions at cost? Yes, our fixed note and additional information tells us that additions are 1,500,000. Do we have a value for disposals at cost? No, we don't, but we know that there are no disposals for land and buildings because there is no value for disposals in the note itself, and there is nothing about disposals for land and buildings in the additional information provided. So we know that disposals at cost is equal to 0 because there are no disposals for land and buildings. Do we have a value for cost at the end of the year? The answer is yes, we do. It's 7,890,720 rands. So now that we have the figures that we need, let's find the cost of land and buildings at the beginning of the year using equation 4. First, we write out the formula, cost at the beginning of the year plus additions at cost minus disposals at cost is equal to cost at the end of the year. Cost at the beginning is what we are looking for. Plus, we said additions at cost are 1,500,000. Minus disposals at cost, we said that's going to be 0 because there's no information about disposals in the question. Is going to be equal to cost at the end of the year, which is going to be 7,890,720 rands. Now we have to rearrange the equation so that the cost at the beginning of the year becomes the subject of the formula. So we want to have it isolated by itself on one side of the equation. To do this, we simply take everything else to the other side of the equation. When we take something to the other side of the equation, the sign changes. So if it was a plus, it becomes a minus, and if it was a minus, it becomes a plus. If something is already on that side of the equation, the sign will just stay the same. When we rearrange the equation so that the cost at the beginning of the year is the subject of the formula, we end up with cost at the beginning of the year, which is what we are looking for, so that's the subject of the formula, equals to 7,890,720 rands minus 1,500,000 rands plus 0 equals to 6,390,720 rands. Number 2 requires us to calculate the disposal at carrying value for vehicles. Step 1, we identify the equation that has the line item that we are looking for. If we look at our equations, which ones have disposal at carrying value? There are 2 of them, equation 1 and equation 5. Let's have a look at equation 1. Equation 1 states that the carrying value at the beginning of the year plus additions at cost minus disposal at carrying value minus depreciation equals to carrying value at the end of the year. This is the value that we are looking for, the disposal at carrying value. So the second step is we fill in the values of the equation. Do we have a value for carrying value at the beginning of the year? Yes, we do. In the fixed asset note, the carrying value at the beginning of the year for vehicles is given as 416,000. 416,000 rands. Do we have a value for additions at cost? Yes, we do. In the fixed asset note, this is shown as 0, which means that there were no new vehicles purchased during the year. Do we have a value for depreciation? Yes, we are told both in the fixed asset note and in the additional information that depreciation on vehicles is 83,200 rands. Do we have a value for the carrying value at the end of the year? No, we are not given the carrying value at the end of the year, but in the fixed asset note, the carrying value at the end of the year can be worked out because we are given both the values for the cost at the end of the year and the accumulated depreciation at the end of the year. Therefore, we can use equation number 3 to calculate the carrying value at the end of the year for vehicles. Remember, equation 3 states that the carrying value at the end of the year is equal to the cost at the end of the year minus accumulated depreciation at the end of the year. So our carrying value at the end of the year is equal to the cost at the end of the year, which is 452,000 rands, minus accumulated depreciation at the end of the year, which is 247,200 rands. This gives us 204,800 rands. Now that we have all the values, we need to work out the figure for disposal at carrying value. Let's proceed by filling in the values. 416,000 rands plus 0 minus disposal at carrying value, which is the value we are looking for, minus 83,200 is going to be equal to 204,800 rands. Since we want the disposal at carrying value, we are going to make that the subject of the formula by taking everything else to the other side of the equation. So when we rearrange the equation, we end up with minus disposal at carrying value is equal to 204,800 rands minus 416,000 rands minus 0 plus 83,200 rands. This gives us minus disposal at carrying value equals to minus 128,000 rands. To get rid of the minus sign, we simply divide both sides by minus 1. So that gives us a disposal at carrying value amount of 128,000 rands. Now let's have a look at equation 5. Equation 5 states that profit or loss on disposal equals to proceeds minus disposal at carrying value. This is the value that we are looking for, the disposal at carrying value. So to make that the subject of the formula, we rearrange the equation. If we rearrange the equation, we end up with disposal at carrying value equals to proceeds minus profit or loss on disposal. Now when we fill in the values, the equation becomes disposal at carrying value equals to 118,000 rands minus negative 10,000 rands. Because we have a loss, we have to put the figure as a negative. This then gives us a disposal at carrying value of 128,000 rands. So that is the value for the disposal at carrying value line item. Number 3 requires us to calculate the carrying value at the end of the year for vehicles. We've already done that calculation, but I will repeat it here. The carrying value at the end of the year, we are looking at this equation. Carrying value at the end of the year is equal to the cost at the end of the year minus accumulated depreciation at the end of the year. So we're taking the cost at the end of the year and subtracting from that the accumulated depreciation at the end of the year. So let's do the calculation. Carrying value at the end of the year equals carrying value at the end of the year equals cost at the end of the year minus accumulated depreciation at the end of the year. The cost at the end of the year is equal to 452,000 rands. The accumulated depreciation at the end of the year, which is 247,200. 452,000 rands minus 247,200 equals 204,800 rands. 204,800 rands. So that's the final answer for the carrying value at the end of the year for vehicles. In number 4, we are required to calculate depreciation on equipment. For the purposes of depreciation, there are 3 types of assets. There are old assets, new assets, and disposed assets. Disposed assets are assets that we disposed during the year. New assets are assets that we purchased during the year. And old assets are assets that were in our records at the beginning of the year. In the additional information, we are told that the company acquired new equipment. There is no mention of any equipment that was disposed, so that means there is no disposed equipment. So this means that the company has 2 types of equipment assets: old equipment and new equipment. We are going to calculate depreciation on the old equipment separately from the depreciation on the new equipment, and then we will add the 2 amounts together to get the total figure for depreciation on the vehicles. Let's start with the old equipment. We are told that depreciation on equipment is calculated at 15% per annum, so that's our depreciation rate on the cost price. So let's write out the equation for depreciation on old assets. Right, the depreciation of the old equipment is going to be equal to the cost price multiplied by the depreciation rate. And this will be limited to the carrying value at the beginning of the year minus 1. The reason why we say limited to the carrying value at the beginning of the year minus 1 is because you cannot depreciate an asset for more than its carrying value. So if an asset has been depreciated over the years and now has a carrying value of 20,000 rands, you can't charge depreciation of 80,000 rands to that asset, because then you will have a negative asset, and fixed assets can't be carried in our books at a negative value. So that's why we must limit the depreciation to the carrying value at the beginning of the year minus 1. When an asset is fully depreciated, we carried it at 1 rand in our books. So that's why we say minus 1, because that's the maximum depreciation you can charge to an asset is the carrying value at the beginning of the year minus 1. So let's fill in the values for our equation. The cost price is equal to 790,000 rands multiplied by our depreciation rate, which is equal to 15% per annum, and all this is going to be limited to the carrying value at the beginning of the year. We said we calculate carrying value at the beginning of the year using equation number 2, which stipulates that the carrying value of the beginning of the year is equal to the cost at the beginning of the year minus the accumulated depreciation at the beginning of the year. So that's going to be 790,000, which is the cost at the beginning of the year, minus the accumulated depreciation at the end of the year, which is 710,000 rands, minus 1. So that means depreciation will be equal to 790,000 multiplied by 15% gives us 118,500 rands, but limited to 790,000 minus 710,000 minus 1 gives us 79,999 rands. So the maximum amount of depreciation we can charge to our assets is 79,999 rands, but we calculated depreciation at 118,500 rands. So that means our depreciation is going to be 79,999 rands, because that's the maximum. Now let's look at the new equipment. The equation for calculating depreciation on new equipment is going to be depreciation equals to cost price of the new equipment multiplied by the depreciation rate multiplied by n over 12. Notice that there's no limit to the carrying value at the beginning here, because the asset was purchased during the year, so there's no value for carrying value at the beginning of the year. The n, when we say n over 12, is the number of months that have passed in the current year since the asset was purchased. So basically we want to prorata the depreciation to the number of months that the asset has been in our books during the current year. That's why we say N over 12. So let's fill in the values for the equation on new equipment. The cost price, we are told, is 150,000 rands multiplied by the depreciation rate, which is 15%, multiplied by 4 over 12, because the asset has been in our books for 4 months. The asset has been in our books since the 1st of November 2023. So from 1 November to 29 February 2024 is 4 months. This gives us a value of 7,500 rands as depreciation on the new equipment. Therefore, the total depreciation on equipment is going to be 79,999 rands that we calculated for the old equipment, plus 7,500 rands, which is the depreciation on the new equipment. This equals to 87,499 rand. Question 1.2.2 requires us to complete the statement of comprehensive income for the year ended 29 February 2024. Certain amounts have been entered in the income statement. So let's have a look at the statement of comprehensive income in the answer book. Here we can see that some values have already been entered. The first thing we must do is to carry forward the values that we have already calculated from the fixed asset note. In the fixed asset note, we calculated depreciation on equipment to be 87,499 rands. So we must add that value to the depreciation on vehicles, which has already been entered, so that we can get the total depreciation amount for the financial year. So we have 83,200 rands plus 87,499 rands. This is going to give us 170,699 rands. Let's have a look at the first adjustment. It says a credit note for 14,400 rands was issued on 29 February 2024 for goods returned by customer P. Mahlangu. Goods were sold with a markup of 20% on cost price. No entry has been made for this transaction. So it means that we must make the entry for that transaction. For the purposes of those who don't understand this adjustment, I'm going to explain it in detail. So if you are comfortable with it, please feel free to move the timer forward to the next adjustment. A credit note is issued when a customer returns goods which the company previously sold to them. This means that the company must now reverse all the entries it previously recorded in its accounting records when the sale occurred. So what were these entries which were made by the company when the goods were sold on credit to P. Mahlangu? The company made 2 entries in its records. The first entry was for the movement of the trading stock. The second entry was for the recognition of the debtor or the raising of a debtor. Let's have a look at the first entry, the movement of the trading stock. Because trading stock is moving from the company to the customer, the company needs to recognize the fact that it no longer has possession of the trading stock by transferring the cost of that stock out of the trading stock account and into the cost of sales account. In other words, we are converting our trading stock from an asset to an expense. The trading stock account is an asset account. Assets decrease on the credit side. So to transfer the cost of the stock sold out of the trading stock account, we credit the trading stock account. Cost of sales is an expense account and expenses increase on the debit side. So to transfer the cost of goods sold to the cost of sales account, we debit the cost of sales account. How do we reflect this entry in our financial statements? Cost of sales sits in the income statement. So we increase the cost of sales line item by the cost of the goods which were sold. Trading stock sits in the balance sheet under the inventory line item. So we decrease inventory by the cost of the goods which were sold. We are not given the cost price of the goods returned, so we need to calculate it. To do that, we use the formula cost price multiplied by selling price percent divided by cost price percent equals to selling price. We are looking for the cost price. Our cost price percent is always 100% because that forms the base upon which the markup is added in order to get to the selling price. We are told that our markup is 20% on cost price. Therefore, our selling price percent is going to be 100%, which is the cost price percent, plus 20%, which is the markup, equals to 120%. Our selling price for the goods is given as 14,400. So when we fill in these values into our formula, we end up with the equation cost price multiplied by 120 divided by 100 equals to 14,400. To find our cost price, we need to make the cost price the subject of the formula by taking everything else to the other side of the equation. We end up with cost price equals to 14,400 multiplied by 100 divided by 120. This then gives us a cost price of 12,000. So that is the value of the stock which the company transferred from the trading stock account to the cost of sales account when the sale occurred. Note that when we take a fraction to the other side of the equation, we switch the fraction around so that the numerator becomes the denominator and the denominator becomes the numerator. The second entry that the company would have made was to recognize a debtor or to raise a debtor for the goods that were sold on credit. Because the company sold the goods on credit, it must recognize the fact that someone is owing it money by increasing the balance of its debtors. Debtors control is an asset account. Assets increase on the debit side. So if we want to increase the balance of our debtors, we debit the debtors control account. We must also recognize that our sales total for the year is increasing. Sales is an income account, and income accounts increase on the credit side. So we credit the sales account. How will this reflect in our financial statements? The debtors control account sits in the balance sheet under trade and other receivables line item. So we increase trade and other receivables by the selling price amount, because that is the amount the debtor owes us. The sales account sits in the income statement under the sales line item. So we increase sales by the selling price amount. So that is what happened when the goods were sold on credit to P. Mahlangu. Now let's deal with the adjustment. Since P. Mahlangu is now returning the goods back to the company, it means that everything that we did when we sold the goods must now be reversed by issuing a credit note. So all the entries that we made in our accounting records are now going to be reversed. So the first entry that we are going to make is for the reversal of the trading stock movement. Since the customer has returned the goods back to the company, the trading stock on hand has increased, and we must reflect this in our books by increasing our trading stock balance. The trading stock account is an asset account. Assets increase on the debit side, so we debit the trading stock account. Since the sale is now being reversed, the costs associated with the sale must also be reversed. So our control account is going to be cost of sales. Cost of sales is an expense account. It decreases on the credit side, so we are going to credit cost of sales. In our financial statements, trading stock sits in the inventory line item in the balance sheet. So we increase inventories in the balance sheet by the cost price of the inventories, which is 12,000 rands. In the income statement, we are going to decrease the cost of sales line item by the cost of the goods that are being returned, which is 12,000 rands. The second entry we must make is for the reversal of the debtor which we previously raised when we sold the goods on credit. By returning the goods back to us, the debt owed to us by P. Mahlangu has been reduced. So to reflect this in our books, we need to decrease the balance of our debtors by the amount of the selling price, which is 14,400. We also need to decrease our sales total for the year by the same amount. Because the debtors control account is an asset account, it decreases on the credit side. So we will credit the debtors control account with 14,400 rands. The sales account is an income account, income accounts decrease on the debit side. So we debit the sales account with 14,400 rand. In our financial statements, the debtors control account sits in the balance sheets under the trade and other receivables line item. So we will decrease trade and other receivables line item by 14,400 rands. Sales sits in the income statement. So we are going to decrease the sales line item by 14,400 rands. Now that we've done the adjustments for sales and cost of sales, we can calculate the gross profit. Say 3,450,000 minus 14,400, which is the adjustments. That gives us 3,330,600 rands. 2,787,500 rand minus 12,000 rands equals to 2,775,500 rands. Then we put it in brackets to show that we're subtracting the cost of sales from the sales, and that will give us a gross profit amount of 3,330,600 rands minus 2,775,500 rands. That gives us a gross profit amount of 555,100 rands. So that's our gross profit for the year. In adjustment number 2, it says stock on hand as per physical stock taking on 29 February 2024. And it says trading stock is 1,239,000. We need to compare our physical stock on hand as per the stock count to the theoretical balance of the trading stock account as per our accounting records. So we are going to compare the physical stock balance to the theoretical stock balance which is sitting in our accounting records. Our physical stock balance is given as 1,239,000 as per the stock count. Our accounting records indicate a balance of 1,230,000. But we need to remember that we have already adjusted this trading stock balance in the previous adjustment by 12,000 rands because P. Mahlangu returned trading stock of 12,000 rands back to us. So that means our new theoretical balance in our accounting records is 1,230,000 that we are given plus the adjustment of 12,000. This gives us a new theoretical balance of 1,242,000. Since the new theoretical stock balance of 1,242,000 is greater than the physical stock balance of 1,239,000, it means that we have a trading stock deficit. A trading stock deficit is calculated as 1,242,000 minus 1,239,000 equals to 3,000. This means that the trading stock account in our accounting records is overstated by 3,000 rands. To correct this, we need to reduce our theoretical trading stock balance so that it matches our physical stock on hand. Trading stock is an assets account. Assets decrease on the credit side. So we are going to credit the trading stock account with 3,000 rands. We must also recognize the stock loss as an expense. So we will create an account called trading stock deficit account. Expenses increase on the debit side, so we will debit the trading stock deficit account with 3,000 rands. In our financial statements, trading stock sits in the balance sheet under inventory, so we will reduce inventory by 3,000 rands. The trading stock deficit account sits in the income statement as an expense, so we will increase that expense by 3,000 rands. For the packing material, we are told that packing material on hand per physical stock taking is 980 rands. Our trial balance extract shows 3,700 rands as the total expense for packing material for the year. According to GAP's matching principle, the packing material expense for the current financial year should be the value of packing material that was actually used during the current financial year. So our problem here is that this 3,700 rands includes the 980 rands of packing material, which is still on hand and is not yet used. That means as things stand, our packing material account is overstated by 980 rands. So how do we get the correct amount of packing material used? We use the formula packing material total minus packing material on hand equals to packing material used. Packing material total is equal to 3,700 rands. Packing material on hand as per the stock take is equal to 980 rands. Therefore, our packing material used is going to be equal to 3,700 rands minus 980 rands, which equals to 2,720 rands. So this is the amounts expensed for packing material for the current financial year. This packing material on hand will be capitalized and will only be recognized as an expense in the financial year when it is used. So to reflect this adjustment, we need to reduce our packing material from 3,700 to 2,720, which is the correct amount. To do this, we credit the packing material account with 980 rands because packing material is an expense and expenses decrease on the credit side. But what about the packing material on hand? We recognize an asset called consumable stores on hand. Consumable stores on hand is an asset. Assets increase on the debit side, so we debit the consumable stores on hand account with 908 rands. In our financial statements, consumable stores on hand sits in the balance sheet under the inventory line item. So we're going to increase the inventory line item by 980 to show that we've recognized an asset called consumable stores on hand. Packing material sits in the income statement as an expense, so we need to decrease the packing material line item by 980 rands. Since we are being asked to make this adjustment to the statement of comprehensive income, in our answer book, we first show our total amount of 3,700 rands, and then we reduce or adjust that amount by 980 rands, which gives us our correct expense for packing material, which is an amount of 2,720 rands. Adjustment 3 states that the debtor Z. Smith was declared insolvent. Her estate paid 55 cents in the rand. An amount of 660 was received and recorded. The balance of her account must be written off. It's very important to note that the amount received has already been recorded. So what's left for us to do is to record the amount to be written off. So how much is the amount we are going to write off as a bad debt? We are given 660 rands as the amount received, and we are told that the estate paid 55 cents in the rand. That means this 660 rand is equal to 55% of the debt that was owed by Z. Smith to the company. It therefore follows that the amount to be written off is going to be 45% of the total debt. 55% plus 45% equals 100%, which is the total debt. So then we can use the formula bad debts written off equals to amount received multiplied by percentage written off divided by percentage received. It's the percentage of what we are looking for divided by the percentage of what we received. Filling in the values, we end up with the equation bad debt write-off is equal to 660 rand, which is the amount we received, multiplied by 45%, which is the percentage to be written off as bad debt, divided by 55%, which is the percentage that we have received as payment from the estate. This gives us an amount of 540. So 540 is the amount we are going to write off as bad debts from our debtors total. To do this, we must credit the debtors control account because debtors control is an asset and assets decrease on the credit side. So we will credit the debtors control account with 540 rand. And then we will recognize an expense called bad debt by debiting the bad debts account because expenses increase on the debit side. This means that in our financial statement, bad debts sits in the income statement and it will be increased by an amount of 540 rands. Debtors control sits in the balance sheet under the line item trade and other receivables. So we will increase trade and other receivables. We will decrease trade and other receivables by an amount of 540 rands. So in our answer book, we are going to add 540 rands to the bad debts line item in the statement of comprehensive income. Adjustment number 4 relates to the provision for bad debts. It states that the provision for bad debts must be adjusted to 21,220 rands. What is a provision for bad debts? A provision for bad debts is a negative asset which is meant to offset the debtor's control account, which is an asset. So the provision for bad debts is a negative asset offsetting the debtor's control account. It is used to reflect the risk that the company may not be able to collect all the debt owed by its customers. It represents an estimation of how much debt the company thinks it will have to be written off as a result of customers failing to pay their debts. This is in line with the GAAP principle of prudence, which requires us to prepare financial statements which reflect a realistic picture of the financial position of the company. The old provision is given as 22,000 as per the extracts from the pre-adjustment trial balance. That means in the previous financial year, the company estimated that 22,000 rands worth of debtors were going to be written off as bad debts. The revised provision for bad debts of 21,200 rands means that in this financial year, the company estimates that 21,200 rands worth of our current trade debtors will have to be written off in future. When we compare the two amounts, we realize that there is a difference of 780 rands, which means that the old provision is being reduced by 780 rands. This is good because it means that the company is expecting to write off less debt than before. Because the provision for bad debts account is a negative asset account, it decreases on the debit side. So we will debit the provision for bad debts account to show that it has decreased in size. The decrease in the negative asset called provision for bad debts gives rise to an income account called provision for bad debts adjustment. Income accounts increase on the credit side, so we will credit this account as well. In the financial statements, the provision for bad debts account sits in the balance sheet under the trade and other receivables line item. Because the provision for bad debts is decreasing and it is a negative account, It's a negative asset. We are going to increase trade and other receivables by 780 rands because the negative asset is being reduced. So it means our debtors, our net debtors are increasing. The provision for bad debts adjustment account sits in the income statement under other income, so we will increase that by 780 rands. In our answer book, we will show the income item provision for bad debts adjustment as 780 rands. In adjustment 5, it states that the premises have been rented for the past 5 years. The rent for March 2024 has been received and recorded. Due to renovations, the rent was decreased by 25% per month for only 3 months from April to June 2023. So we've received rent for March that has not been earned because March falls in the next financial year. So in accordance with the matching principle, we can only recognize income in the financial year in which it is earned. Even legally, we are not entitled to this rent because we have not yet provided that service to the tenant. It will only be provided in the following financial year. The tenant can demand that we return this rent back to them. Therefore, this rent must be removed from the total rent income of the current financial year, and it must be recognized as a liability because we owe that money to the tenant. We have not performed those services. We will only perform them in March of the next financial year. We are told that the rent was decreased by 25% for 3 months, which is April to June 2023. This means that for those 3 months, the tenants were only required to pay 75% of their normal rent to compensate them for the inconvenience of the renovations. We are also told that we've received and recorded the rent for March. Since March falls in the next financial year, this means that the total amount of rent received which is 208,250 rands, is for 13 months. We need to find out how much of the total amount was for March 2024. To do so, we say total rent percent equals to total rent. We then say 3 months multiplied by 75 because we know that for 3 months the rent was only 75% of what would be normally charged, plus 10 months times 100% because we know that for 10 months the rent was 100%. Remember, it's 10 months because we are including the rent for March as well. So altogether, we've got 13 months. 3 months at 75% of the rent and 10 months at 100% of the rent. This equals to 208,250 rands. We then have 225% plus 1,000%. 3 times 75 gives you 225. 10 times 100 gives you 1000. So 225% plus 1000% equals to 208,250. We then have 1225% equals to 208,250 rands. Now we are able to get the value of 1% by simply saying 1% equals to 208,250 rands divided by 1225 equals to 170. So now we know that 1% equals to 170 rands. So now if you want to get the normal monthly rand, that would be the rand at 100%. So we simply say monthly rent at 100% equals to 170 times 100, because we know that 1% is equal to 170. So 100% is going to be 100 times 170. And this gives us 17,000 rands. So that is the normal monthly rent amount. If we want to know what the rent was for those 3 months at 75%, we will simply say monthly rent at 75% is equal to 170 times 75 equals to 12,750. Another way that you can use to get this amount is you can use maths. You can simply solve for x by saying let the monthly rental be x, and then you can say 3x multiplied by 0.75, because we've got 3 months multiplied by the normal monthly rental multiplied by 0.75, because that's 75%, plus 10x multiplied by 1. 10 because it's 10 months. The x is for the monthly rental that we are looking for, and multiplied by 1 because 100% is 1. If 75% is 0.75, 100% is going to be 1. All this equals to 208,250 rands. Then you have 2.25x plus 10x equals to 208,250 rands. To then isolate the x, the monthly rental, so that it becomes the subject of the formula, because we want that figure to be alone, we then divide both sides by 12.25. So once we divide both sides by 12.25, we end up with x is equal to 17,000. So that is the normal monthly rent. X is equal to 17,000. So obviously, if you then want to find the value of the monthly rental when it was 75%, you will simply say 17,000 multiplied by 75% or 0.75, and you will get 12,750. So the normal rent is 17,000, which means that the rent for March, which was received in advance, is 17,000 rands. To show that the rent received in advance is owed to another party, we will remove it from rent income and transfer it to a liability account. We do that by debiting the rent income account because it is an income account and income accounts decrease on the debit side. We will then recognize a liability called income received in advance, or you can say deferred income, by crediting the income received in advance account. In other words, we are converting the rent for March from being an income amount to a liability amount because it is owed to the tenant. In the financial statements, the rent income line item sits in the income statement under other income, so we are going to reduce that line item by 17,000 rands. The income received in advance account falls under trade and other payables line item in the balance sheet. So we will increase the trade and other payables line item by 17,000 to show that we have an increase in liabilities. In our outer books, because we are only asked for the statement of comprehensive income, we will make an adjustment to the rent income line item by decreasing it by 17,000 rands. In adjustment number 6, it states that a debtor with a credit balance of 10,900 rands is to be transferred to the creditor's ledger. Since the debtor has a credit balance, it means that the business is owing money to the debtor. Therefore, this amount should be reflected as a liability in our financial records. To do that, we must transfer the amount from the debtor's ledger to the creditor's ledger. A credit balance in the debtor's ledger can only be removed with a debit amount. So we must debit the debtor's control account with 10,900 rands. Because we want the debtor to show up as a creditor, we must then increase the creditor's control account. Creditor's control is a liability account. Liabilities increase on the credit side, so we will credit the creditor's control account with 10,900 rands. In our financial statements, debtor's control account sits in the balance sheet under the trade and other receivables line item. So we will add 10,900 rands to that line item to show that we are now increasing our debtors by 10,900 rands. Creditors control sits in the balance sheet under trade and other payables. So we will add 10,900 rands to that line item to show that our liabilities are increasing by 10,900 rands. As you can see, this doesn't affect our statement of comprehensive income, so there are no adjustments to make in that statement, but we will need this information later when we do the statement of financial position. Adjustment number 7, it states that the company has 3 directors earning the same monthly fee. 2 directors have been employed since 2022, and a new director was appointed on the 1st of September 2023. 1 director went overseas and was only paid until 31 December 2023. Provide for the outstanding directors' fees. Since the director who went overseas has not been paid for 2 months, we need to raise a liability for those 2 months. The outstanding fees are for January and February 2024. So we need to know what the monthly amount is for director's fees, so that we can add 2 months of director's fees into our financial records. So we have Director 1, who was appointed on 1 September 2023, and they've been paid from September 2023 to February 2024, which is the end of the financial year. So that is 6 months. We then have Director 2, who went overseas and was only paid until 31 December 2023. So this means that they've been paid for March 2023 to December 2023, which equals to 10 months. And then we have Director 3. Nothing is said about him in the scenario, so we can assume that they've been paid for the full 12 months. When we add these months together, we have 6 months plus 10 months plus 12 months, which gives us 28 months. In the extract from the pre-adjustment trial balance, we are told that the current total for director's fees is 1,540,000 rands. So this means that this 1,540,000 rands is for 28 months. So if you want to find the monthly fee for each director, we can say monthly fee equals total fees divided by total months. Total fees is 1,540,000 rands divided by total months, which is 28. So the monthly fee is going to be equal to 55,000 rands. Since we are looking for 2 months worth of fees, because the director hasn't been paid for January and February, we must say 2 times 55,000 and we get 110,000 rands. So to provide for the outstanding 2 months worth of fees, we must debit the director's fees account because it's an expense and expense increase on the debit side. We must also recognize a liability for the 2 months worth of fees owing. So we need to credit the accrued expense account. In our financial statements, director's fees sits in the income statement. It's an operating expense. So in the director's fees line item, we are going to add 110,000 rands. Accrued expenses sits in the balance sheet under trade and other payables. So we will add 110,000 rands to that line item to show that we have an increased amount of liabilities. Therefore, in our statement of comprehensive income under the director's fee line item, we must add 110,000, which is currently outstanding and is owed to the director who went overseas. Adjustment number 8, it states that the loan statement received from ZX Bank on 29 February 2024 indicated the following. The balance at the beginning of the year was 2,509,000 rands. Repayments per month were 75,000 rands. Interest capitalized is what we are looking for. The balance at the end of the financial year was 1,984,000 rands. To find interest capitalized, we use the formula balance at the beginning of the year plus interest capitalized minus repayments equals to the balance at the end of the year. The balance at the beginning of the year is 2,509,000 rands plus interest capitalized. Interest capitalized is what we are looking for, minus repayments. Repayments, we are told, are 75,000 per month, so 75,000 times 12 equals to the balance at the end of the year, which is 1,984,000 rands. Since interest capitalized is what we are looking for, we will make that the subject of the formula by taking everything else to the other side of the equation. When we do that, we get interest capitalized is equal to 1,984,000 plus 900,000 rands, which is the repayments, minus 2,509,000 rands. Interest capitalized is equal to 375,000 rands. Interest is an expense and expenses increase on the debit side, so we debit the interest on loan account. Because the interest is capitalized, it increases the size of the loan. Loans are liabilities and therefore they increase on the credit side, so we are going to credit the loan ZX bank account. In our financial statements, the interest on loan account falls under the interest expense or the finance costs line item in the income statement. So it can be called interest expense or finance costs. So we will increase that line item by 375,000 rands. The loan ZX bank account is aggregated to the mortgage loan line item in the balance sheet under non-current liabilities. So we will increase that line item by 375,000 rands to show that the interest has been capitalized to the balance of the loan. So in our statement of comprehensive income in the answer book, we are going to show that our interest expense is 375,000 rands, and it is calculated using the equation interest capitalized is equal to 1,984,000 rands plus 900,000 rands minus 2,509,000 rands, which gives us 375,000 rands. In adjustment number 9, it says for SARS income tax, 17,000 rands is still payable to SARS. If we look at the information from the extract of the pre-adjustment trial balance, we are told that the SARS income tax account currently shows a balance of 150,000, which is attributable to provisional payments. So therefore we can assume that because it's provisional payments, we can assume that the SARS income tax account is currently showing a debit balance of 150,000 rands. So that means our balance at the beginning of the year was 0. The reason for that is that we can't be paying provisional payments if we are still owing amounts from the previous year. We have to clear the balance from the previous year first in order to pay our provisional payments. And we are already told that that 150,000 relates only to the provisional payments, so that's how we know that the balance at the beginning of the year was 0. Since we are told that at the end of the year there is still a 17,000 rand outstanding, it means that despite having paid the 150,000 rand in provisional tax payments, we still owe SARS 17,000 rands. So obviously that means our income tax expense for the current financial year must be greater than 150,000 rands. So let's calculate our income tax expense for the year. The formula to use is the balance at the beginning of the year plus income tax expense minus provisional payments will equal to the balance at the end of the year. What that is basically saying is that if we want to find the balance at the end of the year, we must take the balance at the beginning of the year, add the income tax expense for the year, subtract any provisional payments that we've made during the year, and we will get the balance at the end of the year. Right, so let's find the values. The balance at the beginning of the year, we said it's 0. Our income tax expense is what we are looking for. The provisional payments, we are told 150,000. And the balance at the end of the year is given to us as 17,000 rands. We want the income tax expense, so we make that the subject of the formula by taking everything else to the other side of the equation. So when you take 150,000 to the other side, it becomes plus 150,000. So we end up with income tax expenses equal to 17,000 plus 150,000. Therefore, the income tax expense is equal to 167,000 rands. In our financial records, we will debit the income tax expense account because this is an increase in our tax total for the year. And when we increase expense accounts, we increase them on the debit side. We will also recognize the liability by crediting the SARS income tax account with 167,000 rands because that amount is increasing the size of our liability to SARS. In the financial statements, the income tax expense sits in the income statement. So we will increase that line item by 167,000. The SARS income tax account sits in the balance sheet under current liabilities, so we will increase that line item by 167,000 rands. So in our answer book, in the statement of comprehensive income, we are going to show that the income tax expense is 167,000 rands for the year. And our workings are income tax expense equals to 17,000 plus 150,000, which is the provisional payments. Question 1.2.3 requires us to complete the ordinary share capital note. In our answer book, some figures have already been filled in. Let's have a look at the additional information given to us. It states that authorized shares consist of 3 million shares. If we look at our notes, we can see that that information has already been disclosed, so no further action needs to be taken. And then it states that on the 1st of March 2023, there were 1 million shares in issue. Again, this has been disclosed, but there's no value for the shares in issue at the beginning of the year, so we will obviously have to calculate that for ourselves. It states that on the 1st of November 2023, the company repurchased 120,000 shares at 7.20 Rand each, which was 20% above the average share price. These shares do not qualify for final dividends. So here we have a share buyback or share repurchase. In the notes, we are given the number of shares that were repurchased, but not the amount, so we will have to calculate that. It also states that 10% of the unissued share capital on the 1st of March 2023 was issued at 6.60 Rand per share on 22 February 2024. When we look at our note, we can see that no entry has been entered for this issue of shares. So we will have to make the entry and do the calculation ourselves. A final dividend of 22 cents per share was declared on 29 February 2024. All shareholders on the share register qualify for the final dividend. This final piece of information is going to give rise to a balance sheet item called shareholders for dividends. So we need to keep this information in mind because it will become relevant when we start preparing the balance sheet. There is also no entry in our note for the number of shares in issue at the end of the year, but we are given the value thereof. So we will also have to calculate the number of shares that were in issue at the end of the year. So let's start from the beginning of the note and see what we can calculate. Are we able to find the value of shares in issue at the beginning of the year? The answer is no, we just don't have enough information in order to be able to calculate that. So it's most likely that we're going to have to calculate it as a balancing figure at the end. So after we've calculated everything else, we'll then work backwards in order to get the balancing figure. In terms of the share repurchase, can we find the value of shares that were repurchased? We know that we calculate the value of the share repurchased using the average price and not the repurchase price. The question tells us the shares were repurchased at 7.20 Rand, which is 20% above the average price. That means 7.20 Rand is equal to 120%. It therefore follows that the average price is going to be 100% because that's the base upon which we add 20% in order to get 7.20 Rand. So the average price is 100%, and the repurchase price is 120%. And we know that the repurchase price is 720, so 720 is 120%. So to calculate the average price, we can say that average price is equal to repurchase price multiplied by average price percentage divided by repurchase price percentage. Just like before, it's what we are looking for over what we have. The equation, average price is equal to 720 cents multiplied by 100 over 120. Therefore, the average price is 6 rands. Now that we have the average price, we can calculate the book value of the shares that were repurchased. And that calculation is 120,000 shares times 6 rand per share, because we know that we've already calculated that the average price is 6 rand per share, equals to 720,000 rands. And then we put that value in brackets to show that our share capital is decreasing because we are buying back our shares. With regards to the share issue, we are told that 10% of the unissued shares on 1 March 2023 were issued at 6 rand 60 per share. So how do we get the unissued shares? We use the equation authorized shares minus issued shares equals to unissued shares. We have 3 million authorized shares minus 1 million issued shares. So that gives us 2 million unissued shares. 10% of 2 million is equal to 200,000 shares. So 200,000 shares were issued. So now we can fill that information into our share capital note. Now we can calculate the total number of ordinary shares in issue at the end of the year as 1 million ordinary shares minus 120,000 shares plus 200,000 shares gives us 1,080,000 shares. Now that we have the number of shares issued, we can find the value of the issued shares by saying number of shares issued multiplied by the issue price. 200,000 shares multiplied by 6 rand 60, which is given to us, is equal to 1,320,000. Now we can solve for the number of shares at the beginning of the year as a balancing figure. Because we are starting from the end, we are going to do the opposite of what you would do when you are starting from the top. So starting from the total of 6,600,000 rands, we subtract 1,320,000 and add 720,000, and we end up with 6 million rands. So that's our completed ordinary share capital note. Question 1.2.4 requires us to complete the equity and liabilities section of the Statement of Financial Position on 29 February 2024. Let's start from the top. For ordinary shareholders' equity, in the additional information, we are told that the net asset value per share on 29 February 2024 is 620 cents. In other words, 6 rand 20 cents. We know that the ratio of net asset value is calculated as ordinary shareholders' equity divided by number of ordinary shares equals to net asset value per share. Ordinary shareholders' equity is the value that we are looking for. The number of ordinary shares at the end of the year we have already calculated as 1,080,000 shares, and net asset value per share is equal to 6 rand 20 cents. We want to solve for the ordinary shareholders' equity, so we will make the ordinary shareholders' equity the subject of the formula by taking the number of ordinary shares to the other side of the equation. When we take the number of ordinary shares to the other side of the equation, it becomes multiplied by number of ordinary shares. So we end up with ordinary shareholders' equity is equal to 6 rand 20 cents multiplied by 1,080,000 shares. This is equal to 6,696,000 rands. Now we can solve for retained income as a balancing figure by saying 6,696,000 rands is equal to 6,696,000 minus 6,600,000, which is given to us, which equals to 96,000 for retained income. Next is the mortgage loan. In the trial balance, we were given the balance at the end of the year as 1,984,000 rands. But we must remember that any portion of the loan which is payable within the next 12 months from the current year end is going to be a current liability. And this is therefore disclosed separately from the rest of the loan, that is from the non-current portion of the loan. We are told in the additional information that the interest and repayments of the loan will remain the same for the next financial year. This means that in the next financial year, we are going to have the same amount of repayments as the current year. This year's repayments were 75,000 rands per month multiplied by 12, which is equal to 900,000 rands. But we must be aware that this amount includes interest. So we must first remove the interest from the repayment so that we have 900,000 rands minus 375,000 rands, which is the interest that was capitalized. And this gives us 525,000 rands. So we must remove 525,000 rands from the balance at the end of the year of 1,984,000 and disclose that separately under the line item current portion of mortgage loan under the current liabilities section of the balance sheet. For trade and other payables, we have our pre-adjustment amount of 774,290 rands, and then we must make the adjustments which we did when we did the statement of comprehensive income, but only those affecting the equity and liabilities section. The first one is the adjustment for rent income. We said we have to increase the trade and other payables line item by 17,000. The next adjustment affecting the equity and liability section of the balance sheet is for the debtor with a credit balance. We said we have to increase that line item by 10,900 rands. Next was the adjustment for directors' fees. We said we have to increase trade and other payables by 110,000 rands. And then there was the adjustment for interest capitalized. We said the interest capitalized was going to increase the loan by 375,000 rands. But we also have to remember that we've already been given the balance at the end of the year. So the interest capitalized has already been included in the balance at the end of the year of 1,984,000. So there's no need for us to reflect this adjustment in the balance sheet. So now we can add our trade and other payables up, and we get 774,290 rands plus 17,000 rands plus 10,900 rands plus 110,000 rands equals to 912,190 rands. The next adjustment was related to income tax. We were specifically told that 17,000 rands is still outstanding. So that is the balance that we need to show for the SARS income tax line item. As you can see, there is one more line item that needs to be filled in, and that will be the amount owed to shareholders for dividends. Firstly, we need to determine the number of shares which qualify for dividends, for the final dividends. In the additional information, we are told that on 1 March 2023, there were 1 million shares in issue. So at the beginning of the year, we had 1 million shares in issue. On 1 November 2023, the company repurchased 120,000 shares. And we are also told that these shares do not qualify for final dividends. So that means from the 1 million shares that were in issue at the beginning of the year, we must remove 120,000 shares that were repurchased by the company. The 200,000 shares that were issued on 22 February 2024 will also qualify for a dividend, because we are told that all shareholders on the shares register qualify for the final dividend. So that means the number of shares will qualify for a dividend is going to be 1 million shares in issue at the beginning of the year minus 120,000 shares that were repurchased plus the 200,000 shares that were issued in February. This gives us a total of 1,080,000 qualifying shares. Therefore, the final dividend amount will be calculated as follows. Final dividend is equal to number of shares multiplied by the dividend per share. This in turn equals to 1,080,000 shares multiplied by 22 cents or 0.22 rands, which equals to 237,600 rands. So in the balance sheet under the shareholders for dividends line item, we are going to show 237,600 rands as the amount outstanding for the line item shareholders for dividends. Now we can calculate our total for current liabilities as 912,190 rands plus 237,600 rands plus 525,000 rands plus 17,000 rands is going to give us a total for current liabilities of 1,691,790 rands. Once we've got our total for current liabilities, we can now add that to the other totals to get the total for total equity and liabilities. So it's going to be the ordinary shareholders' equity amount of 6,696,000 plus non-current liabilities of 1,459,000 plus current liabilities of 1,691,790 rands, and that gives us a total for total equity and liabilities of 9,846,790 rands. That's it, Matrix. I hope you enjoyed this video. Please don't hesitate to contact us now on WhatsApp or via email for more personalized support and videos.